Well, good afternoon, everybody, or good morning. Welcome to another fascinating webinar here at Lendit FinTech, and we have a really interesting discussion today because we're talking about a very appropriate topic. We're talking about building a resilient lending program, and that is something that I think every lender has been thinking about. And before we get started, let me introduce myself. My name is Peter Renton. I am the co-founder and chairman of Lendit FinTech, and I have an esteemed group of panelists here with deep experience in the lending space. So why don't we just kick it off with some short introductions and tell us a little bit about what your company does and what verticals you're in as far as lending goes. And let's go with ladies first. Dawn.
Hey Peter, how are you? This is Dawn Gillette. I'm a senior VP here at NBT Bank. I run our specialty lending portfolio, and I'm the head of FinTech partnerships. NBT is a $10 billion community bank. We're headquartered in upstate New York, and our footprint crosses Pennsylvania, upstate New York, and most of the New England states. And I'm speaking to you from Massachusetts. We have a $3 billion consumer book, about 500 million of which is through our partnerships with fintechs. This business actually dates back to 2007 when the bank invested in a startup non-bank originator before the term fintech was around. And since then we have built a portfolio through custom partnerships with consumer and small business originators.
Okay, thanks Dawn. And Abhinav?
Sure. Thank you, Peter, for having me. My name is Abhinav Anand. I'm a managing director at Goldman Sachs, and I run the lending business for Marcus by Goldman Sachs. For those of you who don't know Marcus by Goldman Sachs, that's the consumer finance arm from Goldman Sachs, have been in existence only 4 years and offers personal lending products, point of sale lending, small business lending with Amazon, as well as Apple Card and savings in UK and US.
Okay, and just to confuse everybody, Abhinav is actually in New York today with a San Francisco background. So.
Yes, that's just my Zoom background. I'm actually in New York City, downtown.
Okay. And Sam?
Hi, Peter. Thanks so much for having me. My name is Sam Sidhu. I'm the Vice Chairman and Chief Operating Officer of Customers Bank. We are approximately 12 billion plus or minus core asset bank community bank based in Pennsylvania. I say core because including our PPP loan efforts, which we did through a combination of a slew of fintech partners, we're approximately an $18 billion bank today. We are predominantly a business bank and have a very small branch light, but high tech, high touch, single point of contact, private banking for businesses type model. However, about 2 years ago, we started a consumer loan portfolio within the bank that's currently approximately 12 to 15% of our total assets. And we started through fintech partnerships. We are the first bank partner of Upstart. We're some of the largest partners of Prosper, SoFi, Marlette. But I think what's been very interesting is we spent a good amount of time learning from our partners, and our current direct originations represent about a third of the book today. And we expect that to grow.
Mm-hmm. Okay, thanks. And Sri?
Thank you for having me. This is an incredible panel here. I'm Sri, founder, CEO of H2O AI. We are the leading platform for open source H2O, which is a machine learning platform that is used by 20,000 companies worldwide. We've also built an automatic machine learning platform, which is trusted by several lenders in the world. Our work in subprime credit scoring with Capital One led off to a phenomenal vertical in consumer and retail banking. So some of the panelists are our customers. Super excited at the partnership here and look forward to telling some of the stories we're seeing. The pandemic has been a unique opportunity for us to lend some of our Kaggle grandmasters. H2O is home to the world #1 and the top 10 grandmasters in Kaggle, and these data scientists are lending themselves to help customers reinvent. A lot of our customers are going through that pain of reinventing themselves to be digital first. Mm-hmm. And we do have customers across every vertical, but I think finance is 40% of our footprint. So super excited to be.
Okay, and just I should also add that we appreciate your support. H2O.ai is the sponsor of this webinar. Okay, so let's get right into it, and let's talk about the pandemic. Sri just sort of prefaced the comments about how it really has impacted business throughout, and I think no business has been more impacted than the lending business. So maybe. I want to actually go back, Dawn, and start with you. And I'd like you to touch on three things, if you would. I want you to talk about how the pandemic has influenced loan demand, underwriting, and what you've done to support your customers in loan modifications.
Okay. So loan demand it's incredibly sector specific. This pandemic is different than every other recession that I've seen. The size of the impact is much greater, and where it's been felt. You have some sectors of the economy, construction, that are doing well, and others that are just aren't even allowed to open. And so that really is what's driving some of what we're seeing out in the market. From a loan demand perspective, we saw loan demand drop, obviously, in late March and April. We saw it where we're doing point of sale activity related to medical, dental. It dropped significantly. We have a solar lending business that did not drop nearly as much. We've seen all of our activity, all of our point of sale lending demand increase meaningfully. Late sort of started early May to June, is sort of stabilized now in July, and we're back up to call it 90% of pre-pandemic. But what we're seeing is some places we've seen demand come back, and other places we've seen it not come back. And there continues to be uncertainty about what will happen tomorrow, what's going to happen with demand and economic activity, obviously, tomorrow. From an underwriting perspective, we have been, I think your question was changes to underwriting. We have taken a very proactive approach, looking at each of our businesses individually and each of our portfolios individually. Through the really shutdown phase of the pandemic, it's first about making sure that that each transaction we're doing is a good transaction. Everyone's always worried about fraud, but when you have this sort of thing happen, it seems to be like a playground, if you will, for fraudsters. So we want to make sure they're good transactions. We want to make sure that our partners, our merchants who are doing the sale at the point of sale, that they're in good shape and that the right things are happening there. And then from an underwriting perspective, we made some changes. We continue to make tweaks to look at what's happening in the short term and what's happening in the longer term, and try to translate what we're seeing in credit bureaus into how it should impact our decisioning. And it's interesting in that this ties to the modification question, in that it's a real challenge because, in previous recessions, lenders experienced higher delinquencies and higher write-offs. Like I think others on this panel, as I was brought up as a lender, and the term was extend and pretend. It wasn't a good thing. But it is a different situation and requires a different reaction. And so that's what we've taken here, is making sure that we're out there lending every day, that we know what we're doing and we're doing it thoughtfully. And we're looking at what's happening in credit bureaus and trying to see through extension activity, what's real, what's lender driven, and what that behavior change is.
Right.
Your third question was modifications. Modifications, extensions, deferrals. We seem to have a lot of words for the same thing. Our approach in this pandemic, it was so dramatic and so instant that we went back and we looked at, it felt kind of like a hurricane. So we went back and we looked at what we did in hurricane situations in the past and how we handled that, and we copied it. And so we reached out to every borrower, whether it was originated through one of our point of sale originators or in our portfolio, and we made it very easy to get an extension. Click here for an extension. We want to make it as easy as possible during this incredibly uncertain time. And it was kind of terrifying to do so because we didn't know what would happen 2 months later when those extensions came to end. And what we have found now, 2, 3, 4 months later, is almost everyone is back to paying. And all but literally a handful of numbers have communicated with us, and we've been able to shrink the universe from a larger pool to just a handful of customers who need help, need additional extensions, or are going to need other situations.
Right.
So that's the approach that we've taken.
Right. Okay. Okay, Sam, I want to move to you and the same 3 questions: loan demand, underwriting changes, and loan modifications. What's been the experience at Customers Bank?
Sure, absolutely. So from a loan demand perspective, I think I would echo what Dawn has said. Definitely for 30, 60 days, there was sort of a complete, everyone was trying to get their footing and really focus more inward from a portfolio perspective. And I think what I would say is, if I look back at the past 90 days, I feel that we have had the benefit of having arguably a higher quality book from a new origination perspective because of the lenders who have stepped out of the market. And many of the lenders that stepped out of the market aren't necessarily stepping out because they didn't recognize that there was a need and demand. It was more so because there was, likely a huge amount of fintechs who had liquidity constraints that didn't have the balance sheet. So we haven't actually purchased or taken any flow arrangements from fintech partners. We've only originated direct since the pandemic has started. So what we're doing is we're managing our portfolio to approximately a flat to slightly negative, decline, and the runoff has been replaced with direct origination. So, I think that we've seen a stabilization, and we do expect that the second half of the year will pick up. There's obviously a question about adverse selection in times like this, and there's a lot of data from previous recessions and also the hurricanes, that Dawn mentioned. We've spent a lot of time from a modeling perspective looking at Harvey and Irma. But putting all that aside, that's sort of how we see loan demand. From an underwriting perspective, we focused on previous, the hurricanes, as I mentioned, which is try to find a parallel to a pandemic that led to some sort of economic recession, as opposed to a purely economic recession focused on GDP and unemployment. So that was helpful from a data perspective. What we found from those periods was that charge-offs, delinquencies and charge-offs were about 2 to 3 times higher for folks that went into deferral. So sort of thinking about how this translates into deferrals, hardship, loan modifications, what we essentially did is we took because we had the benefit of multiple servicers, we took an approach of actually trying out a couple of different models. So in all cases, it was easy for every borrower. But in some cases, with one of our servicers, we proactively, like Dawn mentioned, we called various zip codes, tracking sort of COVID cases by zip codes, and proactively, encouraged folks to go on to deferral. And I think that, that led to higher deferral rates, but those folks came off very quickly. The second thing that we did from a deferral perspective is we had a lot of discussions internally. Should we honor a 90-day request? Should we do 30-day requests? Should we do 60-day requests? And we felt, to the point of not having good data, this is a very unique situation, that a 30-day request would be better, not because we wanted to have a short leash, but we wanted to have the opportunity for borrowers coming back to us and providing us more information and kind of get a sense of how that was, what was sort of tracking. So we'd have at least 90 days of data, sitting where we are today. So I think that's been, definitely very helpful. And I think that, we've also had an opportunity to feel good about our own direct originations and our own underwriting model. Our originations peaked at, less than 4%. And we're currently at less than 30 basis points of deferral. So we've been converting just about everyone back on to paying. Right. And we have a good visibility into our servicers' portfolios across the industry. I think that we feel good about where we are and our credit box, as well as our credit underwriting models.
Okay. Thanks, Sam. And Abhinav, what's been the experience of Marcus during this time?
So there is something similar, but still, given the national footprint and focus on unsecured loans, again, when we look at the demand side, and I'll quote a couple of numbers here because my team was showing it to me recently. The Google search trends on personal loan itself is down 30%. This is at the end of July. So year over year, down 30%. The direct mail in the market by large lenders, including large fintechs, and Sam, you're absolutely right. Most fintechs have pulled out because of liquidity challenges, is down by 44%. So that all of that creates a little bit of a lapse in demand, which you may not see as well. Now, of course, on top of it, most lenders have tightened their underwriting criteria. And almost I feel everybody is now playing into the same very tight box that creates even more complexities. So we have definitely done some prudent changes in our underwriting criteria, very similar to thinking about who are the type of customers that we want to book right now. To be honest, given that delinquencies haven't shot up, people are underutilizing their credit card and using money only on non-discretionary spend, everybody's bureau is looking pretty clean. The key question is, can we ascertain with us a degree of low friction that they're still employed and still have a source of income that can help them service this debt? That's the piece of underwriting that we're more focused on, less so on let's change your DTI cuts, let's change this and that, because all customers are looking really, really nice. Like the FICO has moved up by 15 points on an average for the entire population. So have to keep those things in mind. From an loan modification program perspective, which I'll focus a little bit more, I think Sam mentioned something like high tech and high touch. We use a phrase internally called high tech experience and high touch when required, when customers really want to call you. We created a very simple, very similar to how Don mentioned, a digital way of enrolling. Click a button, no questions asked, you'll be enrolled. And we chose purposefully to go with a monthly enrollment. And you can always come up, and we call it, we can come and re-up. And at the time of re-up, we put an optional survey, completely optional if you want to fill it up or not, to just understand a little bit more about your situation. What's your employment status? What's your income look like? Which industry you are employed in? A lot of good data that allows us to figure out what's the next proactive communication plan, what's the next campaign that we can go after, who do we proactively reach out, who do we let them be more reactive in the next re-up. And very similarly, a lot of those customers just have weaned out. They have, some of them took 1 deferral, some of them taken up to 3 deferrals, but they wean out, and once they have gone through their payment deferral programs, majority of them, like a high 90s of them, are paying well, and those who can't, we are just extending or modifying their loans. So the overall payment rates have been pretty good. That said, we are still thinking through all of these. As every lender is giving a payment deferral. People who have lost their job have got quite a bit of government support. In some cases, people are making more money than they would have made if they were still employed. And if the government support doesn't continue, does all of this move the losses out to next year, at least some of it, if not all of it? This year might end up being the best loss year for most lenders, actually.
Right, which is just crazy, isn't it? Considering
our delinquencies are record low.
Right. Okay, Sri, I'd love to get your perspective. You work with a number of different lenders. What are you hearing from your clients that is it different to this, or what are you hearing as far as what's happening, and how is your company supporting that?
I think great points already made. One of the interesting things we're seeing is that one of the proof of income prediction is an interesting problem. Especially the gig economy has been impacted quite a bit.
Sure.
That's the place where a little bit of the malaise is spreading. But in general, I would say, the government programs, once they get much more and more stable, right, there's a bit of uncertainty in the government support program. I think that would also help kind of give a long-term view for these. But in general, the people are going out less. There's a lot less of possibilities. Our insurance customers are reporting similarly. Windfall or e-tailers are obviously doing really well, and there's a demand sensing that's in general, people used to forecast things for quarters or years at a time. Now they're doing forecasts much more often, so they're using analytics more proactively than going by the gut. So as a result, overall lending programs across the board have stabilized to the reduced demand. Right? So there's a little bit of a supply-demand challenge that has certainly helped, and the rest of the audience, the rest of the speakers were speaking highly about it. Bringing new data into this mix is another thing some of our customers are beginning to think about, but there's generally lack of labeled data. And that's kind of some of the challenges that customers are facing.
Right, for sure. And I want to get into that. And just want to remind the audience, if you hit the Q&A button, you can go and ask the panelists a question. We'll try and get to as many as we can in a little bit. But I want to go back, and several of you have mentioned this, and Sri, you just talked about it as well. The data, there's a data problem that we have not used to here, that, basically in this country, we're blessed with really excellent credit data, and you can have a very good idea of the creditworthiness of the borrowers. But we just don't have that. And I think, Sam, you were saying you've got some certain things you're doing. I'd love to hear from you that how are you determining creditworthiness when the traditional data that you've really relied upon doesn't work? And anyone can jump in.
Sure, I'm happy to start and kick it off. I think that just from even pre-pandemic, the way that we approach underwriting is that obviously FICO is important, and it's the strongest variable in terms of correlation with creditworthiness. Having said that, we do go to multiple credit bureaus to get that information. We do look at obviously the traditional income levels, debt to income levels, use of funds, but we also look at education of the borrower, household makeup, and other types of data points that can really help us get a much more holistic view. And especially in a time like this, there is the potential ability to be asking different questions than we might traditionally ask. And one of the challenges that we have spent a good deal of time trying to sort of think through, and I've kind of touched on this, is credit lenders aren't really reporting to credit bureaus, right? So it's very, very difficult to truly understand the health of a borrower, and that's one of the challenges why it's actually helpful to have a model that goes beyond FICO. Because FICO is a little bit, the model's not being updated, so it's dated information.
By definition, yeah. Anyone else want to add something there?
Yeah, the bureau reporting is become unreliable. So now more than ever, people are going to look at multiple dimensions. And possibly in the community banking situation, you have community kind of giving almost a network of information that needs to be parsed. And I think that interconnectivity between merchants and their users, which merchants are doing well, merchant intelligence has become much more valuable for some of our payment platform customers. And they're trying to come up with going concern predictions for even the small, medium businesses, especially as the government governments world over are supporting through the equivalent of PPP and lending to SMBs. And we've gotten our hands into some of those use cases as well globally. And I think it's an interesting time frame for the world to kind of start looking at alternative ways of measuring. Payment is a good metric for seeing health of the consumer, but is it beyond that once the current state of liquidity reduces, that's government funded, where is the market really at? And that's those sort of kind of concerns that are talking about. Right.
Okay. So we're getting a few questions coming in here. Just a reminder to the audience, if you want to ask a question, please use the Q&A section rather than the chat section. I will get, there are some questions that have been asked in the chat, which I'll try and get to, but the Q&A is the best way to ask a question. And actually, let's just go to one of them right now. So how much do the panelists believe the relatively benign credit delinquency shock that we've observed so far is a function of the $600 per week federal unemployment payments that just lapsed? Do they expect that trends may now deteriorate? Anyone want to jump on that one?
Sure, I'm happy to start. It's got to be a piece of it. I think the other thing is there are the people who have been able to, like everyone on this call, keep their jobs and work from home, are actually in many cases, a lot better financial situations
Right.
they were in before, because they're working, they're earning at some amount of money, and there's nothing to spend it on. So we see lots of data as well as lots of stories about folks improving their financial situation. So higher prepayments, for example, that's what it would look like in a loan portfolio. Refinancing their mortgage, using that to pay down debt, using their excess income to pay down debt. So we're seeing almost like sort of a diversion from the mean in terms of one population getting even better and better from a credit quality perspective. And for those, I think we worry about two things. One, without the $600 a week, there's a group of consumers who are folks who are unemployed who are going to be in a much tougher situation. And as businesses who have been trying to make it through, who had a PPP loan and that got them through, without the PPP loan proceeds going forward, with with economic activity rising to, I don't know, 90% of what it was pre-pandemic, how do they stay in business? And when those businesses eventually have to have cuts, what will happen to unemployment? I think those are the two areas that create the most uncertainty as we look forward.
Mm-hmm. Mm-hmm. Yeah, and I was listening to Marketplace yesterday on NPR, and they were saying the stock market has priced in more stimulus from the federal government.
Yep.
And are you guys pricing that in as well?
Look, I think it's difficult to say we are pricing it in a account level underwriting decision. We are more focused on making sure that you have an employment and
Right.
and what's that likelihood that based on the industry you are in, the geography that you live, that you'll continue to have an employment. But in look at the loss scenarios, you can definitely do effective unemployment rate with a stimulus or without a stimulus, and you can run your loss scenarios for your back book. I'll add to the points that Don were making to kind of expand on it. If you think about it, the last 3 or 4 months, you're spending less, you are getting money through your employer or through the government, in many cases more money than you made, and most banks and lending institutions, which are doing the right thing, are telling you don't have to pay. Guess what happens? You have a lot more savings. Like
Right.
savings rates in our bank, and we have a pretty high APY online bank as well, is pretty high. We're getting a lot of incomings from all types of folks. But the question is, if the government stimulus goes away, or your employers lets you go, and there's no stimulus anymore, and you have to not start spending in some of the things that is really required to sustain life. How does that look like? And the bank deferral programs are also going to end at some point of time. I mean, to quote a number, 6 percentage points of mortgages are on deferral right now. That's a lot of people with a lot of money they're not paying. So how would all of those things unfold? And the biggest uncertainty is, how does the pandemic unfold? If I have to make a prediction, and I'm not pretending to have a crystal ball, but if the coronavirus situation becomes really better and economy starts opening up, then maybe 6 to 8 months from then we'll be in a really good spot. But nobody knows how this will shape up. And one of our biggest fear that we continually track is, so far the furloughs or the job losses have happened in either specific industry or specific income level of jobs. If this thing continues, then other ancillary industries, second order, third order effect, and even white collar jobs would be impacted. So give an example, given the mass affluent customer that we target towards, and if I think of United Airlines as an industry, as a company, I don't think we have too many of the groundsmen or ground people who work on the airport itself as our customers, but we have a bunch of pilots and stewards and folks who work in the corporate office. Now, United has given a warning notice to 35,000 employees, if I'm not mistaken. Then what happens then when they start losing jobs and there's no government support? So those are the kind of things that we think about. All we could do right now is run scenarios and see how it unfolds.
Right.
What Abhinav could have added is the record number of Robinhood and home day traders.
There's a theory behind that. If the casinos are closed and people are looking for other opportunities, and that's where Robinhood is making money.
Right. That's a topic for another time. We've had like 3 questions come in here, all around the same, almost exact same theme. So I need to ask this one. It basically is, what type of data has proved to be more predictive in this crisis?
I think that, I'll start to kick it off. I think at the end of the day, the data that is most important pre-crisis is the same data that's important during the crisis. There's just additional variables, which is credit score and income level and cash flow, right? That's basically those are the most heavily weighted, traditional factors. Now, within the pandemic, we obviously have a very good understanding of the, as Abhinav said, the current immediately impacted industry sectors, employment sectors, but then also have a good sense of what could potentially be tier 2 and tier 3 if this pandemic sort of extends for a longer period of time. So that's sort of how we are thinking about, risk.
Mm-hmm. Mm-hmm. Okay, and then and maybe Sri, you could I'd love to ask you a question about the role of AI here, because I've heard anecdotally that some of the AI-based models are really performing very well, and as far as underwriting models. But I'd love to get your perspective on sort of on how AI is working today.
Oh, thanks for, and also the segue to the previous question, which is what data. Right. So one of the things we did, we started collecting a lot of, along the lines of Johns Hopkins data sets for new cases, Richard. So if you think about just before the almost the second surge that happened across the country, there was some significant positive movement in the economy across the board. A lot of demand started rising for rest of the not just the staples, right, to the rest of the economy. And it was interesting, and that's kind of what we actually anticipated by looking at different data sets of how global trends, right, sort of China has come back with a resurgent economy after the first wave in Wuhan. And I think similar. So if you think of the time series of data, the kind of Asia has contained the virus to some degree of level, and the economic activity that follows after is similar to the economic activity that we should see from the kind of the action reaction that will happen from when we come out of the crisis. And I think now we know how to manage the emotions. And if we look at Q1 or tail end of Q4, Q1, our anticipation is a resurgent economy back, moving to all the backed up demand, if you will, for lots of regular life activities. And I think the cars and transportation, less public transit, more personal cars, using things that we're seeing, trends we're seeing globally will probably we're just phase shifted by 6-9 months. And combine that with what we're doing with our healthcare customers and drug developers, vaccine makers. We're looking, and things look dire a couple of months ago, or 3 months ago, but I think things look much more positive same time next year. The general direction that, there's much more vitalization of the economy, digital, almost all my banking customers are in digital mode. Now, going back to AI, I think there's a couple of really interesting topics I would want to touch there. One is fairness in lending when you're using machine learning methods. We published a recent paper with Discover, the model risk team from Discover. We're working with the MRO offices across all our customer banks, like Wells Fargo and Citi and Capital One, and the groups on the panel. And I think what we're finding is that it's relatively easy to use a black box. It's much more accurate, but applying the same kind of ethical and fairness concerns that we historically applied when we had the human engineered models. I think bringing those same concerns and using it responsibly is something I would put that out there. But in general, we are seeing machine learning able to go across multiple dimensions. Historically, you would have 20 odd variables that would define credit for an underwriter. I think we're both, whether it's from the loan origination, document reading, optimization of that whole loan origination process to actual underwriting, qualification, and kind of servicing process, we're seeing across the board, whether in mortgage business or in consumer lending, AI play a significant role in reducing the time to make a decision and that whole decision-making process, whether through our underwriting, is getting much more rational, much more informed, and I think we're beginning to see different hyper-local ness of the COVID has enabled us to use data that's very local, and how different banks are dealing with the crisis of the decision-making process in the middle of several changing conditions, several new contexts. COVID is a very unique context, and data that was valuable 2-3 years ago is some of it is transfer. You can transfer the learnings from a hurricane season, but shelter in place and the unique kind of season we are in, I think bring on board for rebuilding of these models almost continuously. So AI is almost your driving lights through the fog, and so you absolutely need those lights to kind of to make a better informed decision. Almost all models are wrong. Some models are proving to be useful, and what we are trying to do is make the time to build the models faster, so you can learn faster.
Right. So what about others in the panel, as far as, we're talking about building a resilient lending program? Is AI, what is the role of AI in that? I'd love to hear from one or two of the lenders.
I think there are several components to build a resilient lending program. I do think AI plays a role in that. Again, I'm glad Sri mentioned about making sure that the models don't have biases, and that's a big regulatory point as well. They tend to be more resilient because they're looking at over multiple factors versus just 5 or 7 factors that you have in a typical regression-based model or a scorecard-based model. So that's definitely something important for the situation, and also allows you to rapidly develop new models and put them in market. I'll say though, for building a more resilient business, investments in digital, if you haven't done it so far, is going to be very important because in our case, at least in our business model, given we don't have any branch bank or a physical location, it was easy to move our employees to a virtual work setup, including our call center, be able to continue to originate loans and service our customers through our digital interface. So that would become, in my opinion, really important, that a resilient lending organization would have invested in digitizing their customer interaction as well as their employee interaction. And last but not the least, I do think that for a resilient lending organization, diversification in different industry types, as Don was mentioning, diversification in different channels, point of sale financing comes into mind, especially in e-commerce market, has done very well. And looking at some other products that you can come up with using your existing tech stack, same in point of sale, buy now, pay later, BNPL becomes another interesting aspect to look at. Again, so diversifying your channels and diversifying the type of lending product you're providing would also be a part of being resilient in future.
Right. In fact, let's just take another question here that's actually on that very topic there, Abhinav, which is says, given the flight to e-commerce and the rise of the buy now, pay later players internationally, does this concern the panelists? Given many of the buy now, pay later players are essentially providing credit without updating bureau data.
So I'll take a crack at it, and I'd love to hear the other panelists' view. And there are some really cool players in the market in BNPL, and some of the more traditional point of sale financing players are also getting into that. But if you, a good example of that is Afterpay, really doing very well in the market. A lot of respect for them. They're very smart folks. As long as they're sticking to smaller dollar amounts, and they're asking people to pay off in 4 weeks, I think it's just a different way of using your credit card. It's just like it's 0% APR for the customers. And they're doing a fantastic job in collecting data across thousands of merchants, and that itself becomes very interesting way of underwriting a person's risk. I believe, and I tried it, most of the BNPL player don't allow you more than $50 in your first transaction. After multiple times of using their platform, they build history on you and they move on. The key question, to be honest, is, and I'm sure people looked at it, Citi launched a BNPL play with Amazon, I believe yesterday or day before, going all the way up to 48-month loans linked with the credit card. Those are very interesting products, and that's where I think both banks and fintech have a role to play, have a place to play. The difference would be in the ticket size. Banks would want to play in larger ticket size because operationally it makes more sense. It's a better return. The core fintech BNPL players would play on smaller ticket items. And it's still okay because think of it this way, that's the debit part of the transaction that you don't get to see in bureaus either ways. They're small ticket items. So it's still okay that they don't end up in the bureau. Now, if they become really large ticket items, that will be interesting to see.
Mm-hmm. Mm-hmm. Anyone else?
I think it's the theme similar to, lenders extending rather than having loans becoming delinquent. The data in the credit bureau becomes less valuable. And pre-pandemic, we were all talking about how millennials were using debit cards or using other tools and not using credit tools that showed up on the credit bureau. So we didn't, let someone using just a traditional credit bureau may not have as much information about the behavior of that customer than they would have, than that credit bureau would have provided 5-10 years ago. It's just more along that theme. It's, it's harder to try to figure out exactly how does this consumer behave.
Right.
I think it boils down to customer obsession, right? Sort of knowing the 360 degrees, every dimension about the customer life. What's his DNA? What's his metabolism? What is he worried about? What are his concerns? What's coming up in their lives? I think historically, several of our credit card customers were really focused on the 6 stages of customer life. I think now we're seeing a lot more frequent black swan events, if you will. And so you just need to understand the customer almost on a monthly basis. So BNPL is a great way to get that data, that really data plays, much like how the big, like Amazon, Google, Microsoft, and others have complete information about how different industries are, different companies are, and different people are. I think banks are originally data companies, and we need to get banks back to the forefront of being that curators of data of the customers and understanding them so well. I think the lenders who have found to be really successful in this market are the ones with that kind of empathy for the customer. Right.
Interesting. Yeah. And I think the buy now, pay later space has been one of the most interesting stories, in my opinion, of coming out of the pandemic. And I think it's, it really, the growth of some of these companies, like you mentioned, Afterpay, is just staggering how they've grown. But anyway, let's get on to another audience question here. What trajectory and trend do your banks see coming out of this for personal lending? Are you gaining market share during current environment due to your positioning as a bank versus being a fintech? That's an interesting question.
I can start off. I think from customers bank perspective, absolutely. I think the benefit of having a balance sheet and banks right now are frankly flush with deposits, the highest saving rates, the PPP loans. Folks not spending what they traditionally used to, delaying in investments. Banks have a lot of funding and not a lot of traditional, larger ticket, business loan growth right now. We hope that things will pick up in the second half of the year. So from our perspective, where we traditionally have, I think 12 or so core, fintech partners that help us originate loans. Since the beginning of March, we have only originated direct, and because a lot of these folks have liquidity constraints on their end without having the bank balance sheet and the bank charter, just by nature of that, we are taking market share.
Do you have a timetable to go back to those partnerships, Sam?
Yeah, I think that for the time being, we're also cautious. There are some downsides of being a publicly traded bank. We can have sort of a very thoughtful, detailed conversation here about modeling and how we approach risk. Bank investors, in some cases, not right now, but initially when the pandemic started, unsecured consumer loans was sort of like oil and gas exposure, right? So there was a lot of focus on it. So from our perspective, we've had to pare down what our growth could potentially be from a demand perspective. And we've seen enough direct, and our direct portfolio has been performing best. So it isn't necessarily we only want to go direct, right now. It's just by nature of, we want to basically maintain a flat portfolio. and not necessarily grow.
Right. Okay. Okay, that makes sense. So
probably what Sam's probably not saying is that most of the banks are beginning to act like fintechs and roll out their own fintech programs, which could be competing with the I could call the startups or upstarts. In many ways, it'd be a very interesting year ahead, where many of the banking customers we are seeing are really innovating at this time, and I wouldn't surprise them giving a run for other payment tech companies.
Right. Right. Well, we've got one right here. Marcus, Goldman Sachs was an old, not a retail bank, obviously, but certainly a traditional bank. And now I think you consider yourself a fintech, wouldn't you, Abhinav?
Definitely. We call ourselves a startup within a very large financial institution.
Right, exactly. And so Dawn, what about you? Are your fintech partnerships that you have established? Have you put those on hold, or are they coming back?
So our approach with our fintech partnerships, they're very custom. We're an issuing bank, we're servicer, we're holding most of the loans. We haven't dialed back at all.
Okay.
In fact, we've doubled down in product development and investing in the growth of those businesses. We think there's an enormous opportunity to partner with these folks during a period like this, because if you're out there lending every day and you're able to continue to serve merchants, you're going to set yourself up to be in a stronger position on the other side. And that is the approach that we are taking. So we've invested in product development. We've invested in continue to be out there working with our fintech partners and working with their merchants carefully, intelligently.
Right.
We hope.
Right. Okay.
And we think that leads to huge opportunity. There will be folks who make it through this and others who don't, and being out, putting the effort in to be out there with customers every day, I think makes an enormous opportunity and sets up the opportunities for the next cycle coming out of this. That's been my experience in the past.
Right. Okay, another question we have, this is an interesting one. Have any of the panelists built any models to predict what kind of customers are more likely to require support and deferrals? And are you factoring that into your go-to-market strategy?
We spend a lot of time thinking about that, but it's the inputs into the models are more judgmental than data because we don't have a prior pandemic to pull from.
Right.
Yeah, so
I think from a real-time perspective, it's not playing into originations. We're not sort of tracking COVID cases, versus new loans that are being originated in various zip codes. Having said that, when you take a step back, thinking about the most impacted industries and geographies that link back to industry, not geographies that link to COVID cases, I think is definitely how we're thinking about, from more of a high level perspective.
Mm-hmm.
Yeah, we've looked at, so there's been a general movement away from urban centers. So we've seen people move outside of New York City to go to the rural parts of the world in the early phase of the pandemic, and is sheltered in home in these new places. So demand has changed somewhat in these newer places. So in the past, we looked at the California mortgage. You now have Californians from LA be in different parts of the world, different parts of New York, US, and along the coastline and Gulf. And so that mobility data of the population has informed some of our customers in how they treat calls from these same customers from different geos. It's not necessarily folks who've been under, and I think it's still going after the high net worth, the most valuable consumers in the market. Is still an arms race for that uses machine learning and data. But I think in general, that's what Sam kind of said. The same three variables that were important going into the crisis are still important even now. So.
Okay, so if you want to ask a question, there is 9 minutes left, so you need to get it in quickly. Another one we have here is, and this is an interesting one as well. In this environment, how do you view new customer acquisition through credit versus other products? like Mark, Abhinav, you're talking about the deposit product you have. What's how are you considering new customer acquisition?
So absolutely, look, we all know that multiple relationships lead to more profitable customers and also better credit performance if you have multiple lending products. So we think a lot about that, and this situation has led to a lot of new customers who have come to Marcus franchise through our deposit organization, and many of those are, not all, but a smaller number is a good cross-sell potential prospects for the loans business. So we have actually started a whole program of targeting our deposit customers as they're going through the situation. Now, deposit data, how much they save, do they consider it as a nest egg? All of those signals are important and helpful to underwrite. And that's also a small, not a big, but a small program that we have started just around, I would say Feb. It was a little bit of a happenstance that we're planning to do that either ways. And when COVID came over, so okay, there's no better time than now. Zero CP accounts with customers we already have a relationship with. And as more and more such customers come through, they would provide a potential good base for acquisition later half of the year and next year.
Right. Okay. What about, like, I'd love to get an idea about marketing programs in general. And because we know that a lot of lenders have scaled back paid marketing completely, and we've seen that on some of the publicly traded ones. What kind of marketing is appropriate today, and I know that Dawn, you said you're pretty much back to almost pre-pandemic levels. What kind of marketing are banks doing these days?
So within our fintech partnerships on the consumer side, it's all point of sale. So the marketing that we're doing is building relationships with the merchants, the folks selling the stuff that we finance.
Right.
So it's building those relationships and marketing to those folks rather than marketing directly to consumers. So I think it's a little bit different than sort of the direct to consumer marketing that others on this panel might be doing.
Right. And what about the direct to consumer, Abhinav or Sam? How are you approaching it today?
So from our perspective, from a personal lending perspective, we're really just focused simply enough, given that we feel that demand exceeds, frankly, what we have a capacity to potentially lend. It's really just limited to search engine, optimization and listing. We're not doing anything more than that from a lending perspective. What I would say is that from a business perspective, PPP has been very interesting for us. We brought 100,000 new customers into the bank, over the last 90 days from PPP, and it's actually an interesting overarching trend where the smaller banks and the fintechs, have sort of showed that they can be the winners because they're less anonymous than they would be at a top 10 bank in the country. And I think prior to the pandemic, most, small businesses had a top 5 bank, a community bank, and now I think they've added a, sort of a fintech partnership, in terms of their typical banking relationship. So from our perspective, now that we have this 100,000 borrower sort of new base, we didn't force deposits into our bank. So we actually sent the money out because we felt internally that it was the right thing to do to not delay, the money going out with forcing a deposit account at customers' bank. So now we're spending the time, talking to those customers, sort of attracting them to a digital product, or if they are of the right size and scale, bringing them into our single point of contact model.
Okay. And so, Abhinav, is that similar for you guys?
So I think maybe similar, but with a different twist. And that's where being a bank helps. So we are still using essentially all of our marketing channels, different flex. We have gone deeper with some of our partners when it comes to aggregators like Credit Karma, Lending Tree. I mean, there's a lot of good symbiotic partnerships that we had created in the past, and now we are making it stronger during this particular crisis. Search engines and digital marketing is still going on. Direct mail has shrunk primarily because we don't feel people are really opening mails as much.
Right.
A lot of it to do with the pandemic situation itself. And so but we have still kept it as a channel, and we still do direct mail. The idea being direct to consumer is our primary way of acquiring customers. We need to ensure that our muscle memory remains. We need to make sure that those channels remain viable, because at some point of time, hopefully soon, but even if it happens over time, this is going to turn, and there would be a play to be made for gaining a larger market share. And with the firms that have marketing engines still working, should be able to accelerate. The last piece I'll say is our focus on existing customers has gone up quite a bit more than it used to be. And in some ways, it is giving us a good muscle memory to learn how to present products to our existing customers across the whole franchise.
Right. Okay. We're almost.
Account-based marketing is clearly king, but I would say beyond that is content. So content is still king, and thanks for putting Lendit together now still digitally. We were all looking forward to going meeting people in the evenings and before and during the conferences and after. I think that's kind of what we're doing, spending money on content generation and training and learning centers for our communities. And it's incredible to have such amazing speakers on this panel, and this content is all very valuable. So.
Yep. Well, and as we're about to wrap, I'd like to hear from everybody just on, when summarizing what we've said, but like building a resilient lending program means that we are, it's a program that can survive a variety of different credit environments. So maybe in closing, I'd like to hear from each of you just to give the listeners and the viewers, I guess, just some practical kind of advice about what what are you using? What do you think is the most important thing about creating your resilient lending program today? And Dawn, we can start with you.
Well, that's a tough question in a minute and a half. I think the most important thing is to get up and do it every day.
Right.
Back in March and April, it was a scary time. There was a lot of fear, and you need to not operate out of fear. You need to say, okay, what do I think makes the most sense to do today? You need to ask lots of questions of your data, and you need to make then thoughtful decisions about how you go forward. I think that's the biggest thing that anyone can do.
Okay. Abhinav?
I'll say become a data-driven organization, collect as much data as you can about your customers, invest in digital, and diversify in use cases for unsecured lending. That's the best way to be resilient.
Okay. And Sam?
So I think it's important to continue to lend. I think that, relying on your data and having the conviction to continue to lend is very important. The second would be customer loyalty, is to be in front of your customer in a time like this, build good long-term loyalty, as opposed to sort of focusing more inward and getting paralyzed by risk. And then lastly, I think just, it kind of links back to loyalty, but just from a credit and a risk perspective, it's very important, especially in the unsecured consumer space, to have your borrower stay connected with the loan, and making sure that in a time like this where there's this external factor of a pandemic, you're not just sort of pretend and extend can lead to a major credit issue unless you sort of keep the borrower connected, because an unsecured consumer loan is really the bottom of the pyramid.
Mm-hmm, mm-hmm. Okay, Sri, you have the last word.
Data and more data and customer obsession. I think incredible panels. They've already said great things about how to build a resilient company, resilient business, resilient lending, all pointing to the same. BC is before COVID. I think was a great way to call for us to go digital and invest in our relationships that we always cherish with our customer. We just more touches. It frees us up to do more. Less flying means more time with our own teams. Teams are a bit isolated at this time, so touching our own team so that continue to be cohesively serving the customer. That's something we're finding to be incredibly powerful. AI is here, but still being human is a process, and continue to build that strong partnership with our customers and and the community building aspect has proven to be really powerful. Yeah, thanks for having us, Peter.
Okay, well, thank you, Sri, Sam, Abhinav, Dawn. I really appreciate your comments today. Thank you, the audience, for tuning in, and thank you for H2O for your support for this session. Have a great afternoon, everybody.
Thank you.
Thank
Bye.
you.